Hi there. Good morning, good afternoon, and good evening, wherever you're tuning in from. Welcome to another edition of LATOKEN BCTV. And today we have, I have a new guest. I haven't met Gianpaolo before. It's the first time. And we will be discussing an interesting topic for startups. And if you're a startup, I guess you should tune in, get ready to listen to today's show. Today's show is streaming live. We're streaming live on YouTube. We're streaming live on Facebook and LinkedIn, and we're also live on Twitter. You could catch us on any of these platforms and be part of today's show. You could send a comment or a question, and we could give you feedback in real time. Also, startups are also welcome to pitch as usual on the Latoken VCTV platform. If you have that great idea, that great business, that great concept, put a pitch deck together and come to the VCTV team and we will arrange a pitching session for you online live. Today we will be discussing a topic that I will be keenly interested in hearing the expert feedback from Gary and Gianpaolo. We'll be talking about what it takes for a startup to become publicly traded and what the big deal is. What's the big deal? And as we go into today's session, I'd like our guests to introduce themselves. I'd like to start from Gianpaolo. Please tell the audience a bit about yourself and your background. Can you hear?
The connection, the connection was bad. I mean, you kept breaking up, but anyway, thank you for having me here. I'm Gianpaolo Parigi. I'm a serial entrepreneur, a venture capitalist, and former investment banker. I've been over 10 years on the primary market, so I've done IPOs and delistings and everything that has to do with the regulated markets several times over. So I'm very happy to be here and share a little bit of my experience in the market on this important topic today. Thank you very much.
Awesome. Thank you for that. And Gary, please introduce yourself to the audience.
Yeah, sure. It's great to be here again. Good to see some friendly faces. My name's Gary Fowler. I'm a serial entrepreneur and investor. I've been involved in 17 companies, including a successful IPO of Click Software on NASDAQ. I've been doing startups for over 30 years. I love AI and quantum. Also, I'm the co-founder of Viva.ai with Dr. David Yang out of Silicon Valley, an AI HR tech company. Today, I'm the CEO, president, and co-founder of GSD Get Shit Done Venture Studios, a premier AI and quantum venture studio located in Santa Clara, California. It's great to be here. I also have written 126 articles about AI and quantum. That's it.
Awesome. Thank you for that, Gary. Ariel, thanks for joining us. Please introduce yourself. Let the audience know who you are.
Sure. First of all, thank you for receiving me again, and hello from my fellow friends that are speaking here. So I've been part of a private equity group. We acquired companies that we did a very late stage VC. I analyzed over more than 200 companies in healthcare, crypto, and other industries, also in Latin America and also in the United States. Today, I'm in Israel doing many things, creating a VC from scratch, accelerating space companies, and look forward to this talk.
Awesome. Thank you for that. So let's just jump right into today's session. I mean, we'll be talking about startups and why they should be publicly traded. And I think the first question I'd like to put up out there for those viewing us for the first time and joining the show is, what is a publicly traded company? I mean, what is the big deal? I mean, why would any company want to be publicly traded? Gianpaolo, what's your insights?
Well, the primary advantage of being a public company is that your cost of capital will be lower. That's the baseline, single greatest advantage. So when a company needs capital to grow, the public markets offer you the cheapest capital out there. In a nutshell, this is it. And so if you want just this portion for the moment, I'll leave you just this spiel.
Okay. The reason why I ask is that a lot of startups are more concerned about building their team, building their organization. So why would I want to go public? And what are the benefits of going public or being a publicly traded company?
Well, okay, that's an entirely different set of issues, and I'm absolutely with you. It's not written anywhere that a startup needs to fast track to go public. Also, because going public, besides the obvious advantages, takes with itself also a lot of a roller coaster activity. Just think of this. When an industry sector is affected because of, for example, a scandal or something that's happening in the financial market, every company in that sector will be affected, even if they have no connection whatsoever or no responsibility whatsoever. So being on the public market, that gives you an amplification of your actions, and then exposure, an amplified exposure to the actions of other market participants in a way that it's unfathomable if you are a privately held entity. Normally, privately held entity pretty much live with its own burden of responsibilities, and of course it's affected by the vagaries of its own industry sector. But all things considered, if a company is doing everything it needs to do by the book, it performs well, it has a recognition. Sometimes in the public market, as I say, we can have a booster effect, because there is a Venturi effect of being sucked into a curve of growth in the stock appreciation if a whole industry is going up. But by the same token, you could be in for some roller coaster and very steep incline, which is totally unrelated to how your own company is performing on a day-by-day basis. So because you are put into a different system, in a different machinery, I don't think that there is a golden rule for when and if a company should go public. I know that there are several different points of view on this, because each one has its own merits and deserves consideration. But ultimately, it depends on the management of the company, if it's I would say relatively large entity, or on the founders if it's a smaller company like a startup, to determine whether or not that type of pattern, that type of route is good for them or not. And as I say, I would invite everyone that is considering even remotely the idea of venturing on public markets to consult with specialists, investment bankers and attorneys, and CPAs, tax attorneys and accountants, to ensure that the risk, responsibility, awards and honors are well represented to them, and so that then an educated decision can be taken. Thank you.
Thank you very much. Thank you very much for that. Thanks for the comments coming up from Facebook. From Ovan, we see you. Frank, we see you. Thanks for the likes and the support. Gary, you've been involved with a lot of startups. You have held C-level positions in some of these startups. Tell me, why would a startup want to be publicly traded? And just expatiate on what you would advise or recommend for a startup.
Yeah, so I went through, so we did a NASDAQ IPO with Click Software, Israeli company, many years ago now. Wow, a long time ago. So, what's it why did we do it? Well, the reason we did it at the time was to raise money. So, when you take a company public, it's called an IPO, initial public offering. It allows you to be able to sell stock that the general public is able to buy. So a lot of recognition. In our case, we were listed on NASDAQ, and it gave us a lot more credibility when you go from private to public. But it's a lot of work too. So you've got to hire a investment banker. The first steps: hire an investment bank or syndicate group of investment bankers, underwriters. So a lot of paperwork and due diligence and verification. So there's just an incredible amount of opportunity that it just gives you a lot of visibility. What can I say? So, in terms of the process, it's an extensive process. You've got to evaluate these offers you get from the investment bank. Generally you get like 3 to 5 institutions to make a bid. They'll talk about what your valuation is, how they expect your stock to perform. Then they look at it. They're doing all this research and analysis. And anyhow, for us, it was visibility, right? When it's all said and done, it was a lot of visibility and a lot of fun, Nathaniel. Get to ring the bell in NASDAQ in New York.
Yeah. That's one too.
Listen, ringing the bell is a big thing. And that company, by the way, was sold to Salesforce for $1.35 billion. So 2 years ago, a little over 2 years ago. So it's
Awesome.
it's an incredible experience, and a lot. You want to make sure you have the right team, because they go down through and verify who everybody is. They do background checks, that kind of thing. Because what you don't want to do is to get in lawsuits after the fact. After you do the IPO, you don't want to have challenges and problems. So, it's an interesting experience, to say the least.
Thank you very much. So we got it right there from Gary that for his own scenario, it was to increase credibility for the company and then visibility. And that's what probably got you the 1.35 billion sell-off. So, I mean, that's a valid reason. Ariel, I mean, do you have any thoughts on the reasons why a startup will want to be publicly traded?
Sure. I won't address the pros and the cons that were said here, but I want to focus on what it takes for a startup to become publicly traded, which is the topic where we're talking today. But before I do so, I want to mention two things. First, I think that there are a right stage, in my opinion, where a company should think of going public, which is where it uses. By the way, being private is also a great stuff for a company. That's why companies are not born public; they are born privately. And for example, when you give stock options to employees, which can really attract great talents, is the powerful tool. When you're publicly traded, that becomes something even more valuable. So when you feel that you're starting to become weaker on your options while you're private, then there's a state of thinking of going public. Other things is, as Gianpaolo said, perfectly simple. I perfectly agree. It's lowering your cost of capital. It's financial wise. It's gaining visibility, even though you could do that in other ways. But I think going public is more putting a stamp on a company and saying this company is like now completely verified, accounting wise, financial wise, product market fit wise. It's understandable now for more way less risk averse investors and very big institutional investors and pension funds and people that wouldn't get to this company before, so because was maybe considered a riskier investment. Now it's considered more a safer one. So these are the pros, but the cons, obviously there is this cost of filing. But if you're a profitable company growing fast, you shouldn't care about that. But there is what happens to a lot of companies is there's a huge regulation and compliance with public companies, and as companies grows, there is a big effort by the company to report this and create this filing with the SEC. A lot of attention of the company can be dedicated now to hit quarterly numbers, and a lot of innovation sometimes that stop transitioning, it stopped being what it was when it was private. So companies need to pay attention to that. So with that being said, I think what it really takes for startups to transition from private to public. By the way, we talked recently here about specs. If a company has already a good name in the market and is really looking for transitioning fast to public company, it should really think about the spec, getting the right investor with the right industry expertise. That's an invaluable tool. But if we're talking here now just about a normal roadshow, a normal IPO, I think a startup needs to reach a place where its initial market it's well done. It has already really strong foothold in its market, and it now wants to expand to a secondary market aggressively. It gets to a point where it conquered a lot of things. It has a solid milestone behind the company, but now it wants to go. It wants to dominate a way bigger stuff. So when he hits this moment, and it's really a strategic decision. I don't think so much it's a pure financial decision to go public. When the company hits this stage, then I think it's wise for a company to go public, because in the end of the day, what are people doing in secondary markets, which is where they buy low, they sell high, they want the stock to go up. So, and when a startup go public on this moment, after the IPO is done, there is a significant appreciation of the stock because they see future value on it. But if you do that before such event or after such event, such appreciation for investors can be something that it's let's say not as expected, and it can hurt the company in the long term. So it's a really strategic thing. There are a lot of things that need to be taken into consideration, but I do think there's a more or less the right time for a company to go public.
Awesome. Ariel, thanks for pointing out that there's the right time for startups to consider going public. And obviously, this is not meant for every startup. So, Gianpaolo, please, since we know this is not meant for every startup, can you give us a guide on which startup, at what stage do you get to that you realize that going public is the best way forward? And really, does it matter the exchange you get listed on?
I'm sorry, does it matter what you said?
Does it matter the exchange you get listed on?
Okay, well, let me backtrack one moment. I would say there's an important aspect that needs to be considered, because if you go on a website of any regulated exchange, you will see a list of parameters that you have to comply with as a potential applicant, as a potential issuer. On the other hand, I could tell you, when you get into the nitty-gritty of it, when you go granular, every exchange will present you with additional parameters, substantial parameters that you have to respect and comply with, in addition to the formal requirements that you see listed. I would say that to a degree, it could be taken even as a sort of moral suasion in certain cases, because of course, one thing is to list, a multi-billion euro or a multi-billion dollar company already, and one thing is to list a small cap, or in fact, we consider small cap companies that have a market capitalization of 3 billion. Most startups do not have that. So we're talking really more about nano cap and micro cap in our line of business. And again, when you bring a nano cap or a micro cap to the market, the moral suasion of the regulators could be exerted differently than if they were sitting in front of an established multinational or a successful brand, household name, obviously, or a financial group. So, there's a lot of, differences and nuances in the granularity of the actions. There are differences also depending on the exchanges, absolutely, because one thing is if you list in an emerging market, another if you list in a completely advanced economy, and there are the industry sector you're in. because part of the moral suasion that some of the listings would not write down on their website, but they would tell you once you approach them, is every stock exchange likes to project an image of itself with certain industry sector that they predilect. And if for some reason your startup or your company is not among the favorite industry sectors, well, I mean, they will not turn you away and refuse, but maybe they will gently let you understand that possibly you could address yourself elsewhere for the listing. There's a lot of things that startups might be confronted with that, as I say, do not appear in the gloss of the websites, and only by actually being on the trade you will see this. And again, I think every startup has to just perform this simple exercise of taking a clean blank sheet of paper and divide it longitudinally in 2 columns and put the pros and cons of the listing. On the pro side, we put definitely the cost of capital, as I said before. We put definitely the visibility that Gary was mentioning, because obviously you got visibility. I would additionally put it as another plus, the relative liquidity on an exit that you would have versus, of course, being on a privately held entity, because if there is the equivalent of foot traffic on your stock, meaning there is at least a decent intraday trade, obviously you have liquidity possibilities that are much better than if you are private. And I would say those are three big elements. Let's put a fourth one, which is definitely the increase in the enterprise value, overall capital appreciation of your holdings, because as a result of having funded your company in a cheaper way, as opposed to other forms of financing, obviously you can create the conditions for a more harmonic growth and a better EV than if you were not public. On the other hand, as I say now on the second, and there are other benefits, but those are, I would say, the cornerstones of the pluses. On the minuses side, I would definitely put, hey, you're gonna be on a roller coaster in which you have no say whatsoever as to where the market is going. You are just, buckled up and strap onto your seat, and you go on this roller coaster, and it's exhilarating at times. It scares the hell out of you. Other times it could be inflicting big penalty to your market capitalization if something in your industry sector or in your geography occur which is a negative for what we consider the consensus in the financial market and in the public opinion. So there could be a number of issues that are completely independent of your capability to engage on complex issues and to deal with complex issues, because they are macro issues beyond your reach. So but you are the flip side of the coin in this case, that you just got the flip side of the coin, because you end up having to endure whatever bad situation the market is throwing in you as a result of your company being in a certain cluster or in a certain industry sector or on a certain stock exchange. Just to remember what happened in Dubai in what it was 2008, when there was a global financial crisis, and the meltdown of many economies, and there have been stock exchanges that have been heavily affected, also reputationally, by the scandals occurring in certain jurisdictions. So, if you are in the wrong location and the wrong time, well, it's too bad. You have little or no recourse. And again, you have some other minuses. The fact that visibility also calls for hostile takeover attempts. Obviously, if your business is successful and you begin to accumulate cash, sure enough, you become a target of raiders, corporate raiders, because you become a target for friendly acquisition, but also for hostile acquisition. And of course, being on a regulated market, unless you're the darling of the market makers, which chances are you will not if you're a startup, there is very little protection about your companies being silently raided day after day until you discover that there is somebody ready to exercise a public offering and a squeeze out of other shareholders. So you could find yourself in theaters of battle fights that are entirely foreign to you as an entrepreneur. And again, not being a major, not being a blue chip, you are also left alone by the broker dealers. I mean, I could tell you stories of successful IPOs made on even financial institutions in the multi-billions of dollars of market cap, and they have been dumped by the biggest broker dealers out there after a few days that the IPO was consumed, just because they were not big enough or interesting enough to generate the type of foot traffic equivalent in a shopping mall that I was saying. So you imagine if something like that to be dumped in terms of trade by the large market makers can happen to a multi-billion company, what could happen to a small ant that is a startup out there? And again, maybe you're a unicorn. Gary's got definitely experience on that, and he can elaborate. Then, it's very good for you, because you're growing fast and good, and you are developing your antibodies resistance and the immune system as a company to not only defend yourself, but also to possibly become yourself a predator up the food chain. But most companies are not unicorns. In fact, very few are unicorns. Everybody else, it's a good company or mostly a mediocre company, and those are at totally exposed at the vagaries of the market. So on the let's say right hand side of this ideal piece of paper that I just mentioned, you could find a lot of minuses, but especially you could find some minuses that are very dangerous for your own survival, or anyway for the net worth of the founders. Let's put it like this: maybe the company can be taken over, but you can get kicked out and squeezed out.
Thank you very much, Gianpaolo. That's a lot of information to process, and I'm sure our audience will be paying attention. And just in case you didn't catch some of that, you could easily go back to our social media after this show and watch the whole show over again. It will be on YouTube, it will be on Twitter, it will be on Facebook and LinkedIn. And Gary, with your experience and with your exposure, how do founders of a startup protect their company as it's going public, and how do they ensure that it succeeds, so to say?
Well, so how do they protect it when it's gone public? It's I'm not sure which direction you're taking on it, but when they're going public,
the direction I'm actually taking is part of what Paulo mentioned about the hostile takeover thing, and it's every founder's nightmare. So, when you're taking your company public, is there a certain way to protect your baby? And how do you do that and then still ensure that your company succeeds?
The one thing, Nathaniel, got a lot of obligations, right? Such as SEC reports, keeping shareholders in the market informed, what's going on with the company, your financial condition, the management. You take you accept a lot of burdens, scrutiny, right? So it changes the company, because the company and the executives may be liable with all these new obligations if they're not satisfied. So you lose flexibility in managing the company, especially when public shareholders have to prove the company's actions, right? So you're not really as in control of your destiny as you were before. So, information about the company, financial statements, required disclosures, contracts, customers, suppliers need to be available, and many times to the general public. Well, of course, then your competitors can look at them. But on the other side of it, why would you do it? Well, think about it. Well, one is you want to raise capital, which is what we did at Click Software, because the market had turned south. We still wanted to do an IPO, and we needed to raise capital to succeed. because the market was downturning. Then at the same time, once you increase your liquidity for the stock, it allows the owners and employees, right, to be able to sell their stock to make a lot of money. So everybody wins on from that standpoint. The other thing is, imagine you're a company in a particular market, but you can really complete your solution by buying other companies. So it allows you to be able to acquire other businesses with the company's publicly traded stock. So that is really interesting. And the other thing is, quite frankly, what we did, it was a whole lot easier to attract and compensate employees with publicly traded stock and stock options to get them interested in coming on board. It really changes it. I mean, people, what do they talk about in Silicon Valley? When you go to a company, is what kind of stock, how many options do I get? What's the vesting schedule? 2 years, 4-year vesting schedule. And the other thing is, when you're going public, you create a lot of visibility, publicity, brand awareness and prestige for the company. So it really changes the dimensions of everything, and it makes it really interesting. I know for us, it gave us a lot of visibility. It was easier to get agreements together with larger companies because they know who we are. Everything was public, if you will. So, I mean, you assume a lot more responsibilities and take on legal requirements, but at the same time you raise money. So the one thing about being a privately traded company, you can make your own decisions, right? It's you have investors maybe or not, but you can make a lot of your own decisions. But once you go public, there's a whole lot of requirements you got to suffice and make sure you're compliant. So when you're doing contracts, what kind of contracts you can and can't do. So it's the devil is in the details. You got to make sure that you have the details correct, because nothing good is going to happen if you don't.
Thank you very much. Thank you very much, Gary, for that. Ariel, over to you. I mean, looks like you have some thoughts and insights over how a startup can ensure its success after going public.
Is that for me or for okay?
No, for Ariel.
Yeah. So Gary and Giampaolo touched on great points here, so I'll do my best to go beyond that. And I think that, listen, another thing that I think it's not talked a lot is when you're publicly traded, the contract that you get, the price offerings that you get on them, the terms, you have a lot of negotiating power. You can, for example, one thing that can break a company, if we're not talking purely on software here, it's a relationship with customers and your management of cash flow. That becomes significantly more interesting and easier once you're a public company. You have a lot of bargaining power, and that by itself can release huge amount of value. Now, you don't need to go and do a secondary and bring other investors. That by itself can better the position of the company tremendously. With that being said, also something that we need, I think, to mention on this talk is what's thought about going public today. Going public today, it's thought about because maybe the boom on the startup world is that you grow a lot, you become like a unicorn privately, and then the IPO or the SPAC or going public is that event that all the private investors are waiting for. Their exit, and on the same boat, it is another fundraising for the company. But there are a lot of companies we can't forget about them. They go public when they're small. Actually, before there's that huge amount of growth, and there are those unicorns. It's not a rule. I think it's more of an exception today. But that exists, and I think that needs to be on the radar. There is not one and not two examples of companies that were public and nobody looked at them. We weren't even trading on NASDAQ. They were trading over the counter. They were upgraded to NASDAQ, and they some succeeded, some don't. But the ones that did released a huge amount of value. So going public doesn't need to be. If we talk about the specific situation that we are right now, and by the way, just remember that a really small percentage of startups become these unicorns if you get the overall number of startups that are founded every year. So very few get to the stage of this classic IPO that we're talking right now, where investors get their exit, the company raised additional funds, and yada yada. But there are companies that go public and go through the listing and become compliant very, very early on their way, and actually use these tools of being public, but with a bargain. They, as Gary said, they go and acquire other startups and way back and use already these instruments of being public far behind, and sometimes it can be very bad for them, but sometimes can be very good for them, and it lowered their overall trajectory, the overall cost of capital, their overall bargaining power. Because when you're a startup, it's sometimes it's hard getting a bigger supplier or a bigger customer, negotiating stuff. People don't trust you, people don't know you. But if you're a small startup and you say, listen, I am public, that's surprising. We don't see that every day, but that exists, and we need to talk about that. But that gives a lot of power to a startup. I'm not saying that every startup should do that. There are specific reasons why you should and should not. But just for founders to have in their mind that IPO and going public, it's not just when you're huge and you're already hitting huge CAGRs and you have a RRR of average recurring revenue of millions already. But a public company, theoretically speaking, according to regulation, we can file to a public company anytime, anywhere. By the way, what are blank check companies? They have nothing inside of them. They have just cash sitting inside of them. They have no operation. They go public. So any type of company in any stage can go public. So let's just not forget about these companies that when they are way back, they can do so. But that's not the traditional that we're speaking here. So going back to what we're traditionally speaking here, which is what people have on their minds when they think about IPO, when they think about going public, let's not forget that now valuations are disconnected from fundamentals, and across all markets. And also, when you are becoming public, the valuation of your company will change dramatically. It's either for the bad, for the good or for the bad, it will change dramatically. And founders need to be pay close attention to that. I know that we talked here about aggressive takeovers and this kind of stuff. In a scenario where you have really discrepancies between fundamentals and valuations, this needs really to be paid attention to it even more. And with that being said, listen, I think in the end of the day, the process of making a company public, it has its pros, it has its cons, but overall, it's a healthy process. Overall, weeds out companies. I don't think every company should go public. It weeds out companies that shouldn't. It brings it to the market the company that should. Regulations, maybe sometimes they have too much regulations, but regulations are overall good. Having these regulations to comply to them, it's good for investors. It's good for the company to double checking itself and making sure that the business stands. And overall, I think it's a great choice for a company when it meets the right moment with the right partners and with the right business conditions.
Awesome. Thank you very much, Ariel. I mean, you just highlighted that while there are pros and cons, there are, it's important for every startup to figure out if this is a good option for them. But while you were speaking, you talked about types of exchanges and listings. Can you expatiate on that, Ariel?
Sure. I didn't understand your question. Can you repeat it?
You talked about types of exchanges and types of listings, over the counter and stuff like that. Can you expatiate?
For sure. So for a first stock, for public equity, there are kind of two ways it can be traded. Okay, it can be traded on exchanges, which is what we normally know. It's on NASDAQ, it's on the London Exchange, it's in the New York Stock Exchange. So it's when you go to your broker website, you see all the numbers crossing your screen. So this is stocks that are traded in centralized exchange. Now, not everything that is public is traded in centralized exchanges. There are things that are traded what is called OTC, over the counter, and that is it's public. It's publicly traded. It's reported with the SEC, and if we're talking now about United States, but it won't be exchanged on on a central exchange. And that happens with kind of, for example, if we're not talking now about stocks, but if we're talking about more complex financial instruments, they are traded like this. But about really small cap stocks, they are traded like this over the counter. If you never heard about, I mean, it's not. It's just everything that's not an exchange. It's over the counter. And what I use that in the context, saying when really small companies, way smaller than microcap, that Gianpaolo said, like really small startups when compared to blue chip stocks, like with a market valuation of 100 million, so it's something really small. They are traded over the counter, and when they meet the parameters for upgrading their listing, when they grow and they have their Nasdaq, for example, has specific parameters of revenue and number of investors and other things. So when they hit these things, they are allowed to be traded on exchange. So not everything that is public is in Nasdaq on New York Exchange. There are a lot of equities that aren't. Founders need to be aware of that. If you're a small company trying to do a listing, and we're not talking now about a unicorn, it may be that you won't go and get listed in a stock exchange. Maybe you stay over the counter. So for this is the exception, but I felt it was important touching upon that, and founders need to be aware of that. Now, if we're going back to unicorns and really growing fast startups, you won't face this world. You will for sure be listed on a major stock exchange or Nasdaq, and this will be the reality for your company.
Thank you very much, Ariel. I mean, a lot of information for the audience to process, and it will be interesting for them to go over this content again. Guys, we've come to the end of today's session, but Gianpaolo, please, what are your parting thoughts and insights for any startup founder watching this show right now?
Well, as I say, the first job of any entrepreneur is to, like the captain on a ship, is to ensure that the vessel is seaworthy and it's on route to reach whatever destination it has to reach. This is the first job, because fundamentals always apply, and even prior to deciding whether or not the company should remain private or go in public, the founders, entrepreneurs have the obligations towards themselves, their investors, their employees, and the stakeholders at large to ensure the survival of the business and possibly the growth of the business with a sustainable model that can be vetted and validated irrespective of the fact that the company remains private or goes public. Because, if a model is viable, it's viable. Once a company can generate revenues sustainably and possibly increase in margin over time, other options may present themselves. And as I say, I think that would be the right moment in which to consider whether or not at the bifurcation on the road, you have to go left or right, stay course or alter course. But until you don't have a really viable business model and solid revenue generation, I would definitely not recommend anyone to even remotely try going on to even the OTCs, like Ariel has mentioned. OTC has a lot of advantages, for example, and OTC equivalents in the other markets outside the United States and Canada, because those markets are characterized by a very limited. Again, I speak with the jargon of a shopping mall, so everybody understands. If you open up a shop in a shopping mall, you have no foot traffic, you're in for some problems. And the same token, if you are on a stock exchange where you have no foot traffic because trade is limited, or trade on your ticker is limited, then you're in for troubles, because several things can happen. Well, first of all, you have to find someone at broker-dealers level that believes in what you're doing, and they have to, what we say technically, support the trade. And those support contracts with investment banks are quite expensive. People tend to believe that the IPO is the end of a journey. And I always say, look, the IPO is actually the beginning of an entirely different journey, like Gary just said minutes ago. It's like you change sports. You go from basketball to a volleyball. Yes, there is a ball, but the rules are entirely different. I mean, you're still dressed in your, athletic outfit and gear, but it's totally different rules of engagement. And there are some similarities with what you did in the previous sport, but it's a different sport altogether. So, as I say, having support costs a lot of money in the fixed expenses and fixed fees that you have to pay, irrespective of the results that you may get. And also then you have variable costs and fees associated with that. And it still may not be enough to guarantee your vessel to remain afloat. And the second thing that can happen, if your vessel doesn't stay afloat and is at risk of sinking, of course, the watchdog on that particular stock market may suspend trading on your stock, and you may be more or less then, depending on how things go, forced to even do a delisting. So there's a lot of very costly situations from which you have no escape. Once you're in on that track, you gotta go on that track. And again, if you entered the field without having very clear ideas, and moreover without having a sustainable revenue generation model, you're in for some very, very bad awakening, a rude awakening, and costly awakening. With that said, I thank you all for joining me today, and I will leave you with that. Thank you.
Thank you very much. Thank you very much, Gianpaolo. A lot has been said, and notes have been taken, I'm sure. I've taken notes. So, Gary, final thoughts, your insights to start.
Yeah, so Gianpaolo's right on target. I would just say I compare it to the difference between, playing sports, on a playground and the Olympics. You get out there and you start to play, and you got a lot of competition. It's a lot harder, but there's a lot more rewards. So the key is to be able to win. There are a lot more financial responsibilities, but at the same time, there are a lot more rewards. So it's exciting times. It's not for everybody. Some people want to have businesses that stay private, that really are more lifestyle oriented, if you will, that have private investors. That's cool. But, it's a challenge. Do you really want to win the Olympics or not? And so doing an IPO is like that. So you can reach me, Gary Fowler, on LinkedIn, Twitter, my shows. I've got, I do about anywhere from 17 to 20 shows a week. So tune in. And great to be here. Thank you.
Thank you very much, Gary. Lovely insights. Ariel, we come to you before we go. Final thoughts.
For sure. So to close this discussion, I agree with everything that's being said here. I think that it's not for everybody. I think it's a really healthy process. I mean, if your company decided to do so, I think it's a huge addition to the markets when it becomes public. It's a new equity. It's a new flash. It's more competition to the market, and for the final consumer and for investors, the more equities and the more companies in the market, the better. So I think it's a really good process. It's not for everybody, but agreeing with what Gianpaolo said, your company needs to be 100% ready. I mean, don't see IPO as an exit, and after that you're gonna just have a good life with that cash, and you'll have a good cash compensation if you position yourself well before. So, but I totally agree with what was said here. It's just the beginning of another journey, and I think that the most important thing, shall you decide that this is what you have for your company and this is the right step, make sure to get the best advisors. Make sure to have a really solid legal team. Make sure if you were a company just really focused on product and marketing and a lot of things that started need to focus and develop to make this the startup really scale. Now you're getting to another league. You have to invest time and effort and capital in developing a good advisors, a good legal team, a good financial team, really good foundations for the business if it didn't have yet, to be able to go through this IPO successfully and to have a good time in the public markets. With that being said, I thank you all again having me here. You can find me on LinkedIn as Ariel Fogelman, and hope to see you all soon.
Thank you very much, Ariel. Thank you very much, gentlemen, for being part of this show. Thank you for your contributions and insights. I'm certain that the audience had a good time, and we'll definitely come back to this video on our social media. And I look forward to having you guys at the next show sometime in the future. Thank you very much, and bye-bye.